investor. We're talking real money.
Volatility. It seems that, according to a poll, 64% of you are worried that the market will continue to be volatile. Well, let me just tell you a little something. For the 36% who don't believe the market will be volatile, you're wrong. All of you are wrong. The market will always be volatile. What people are worried about is not the volatility. We're making a mistake in our use of the word. We're not using the word volatility properly. When investors think volatility, they don't go, oh my gosh, look at how much the market is going up. It's so volatile. It's going up like crazy. It's up 50%. Oh, it's too volatile for me. They're going, oh, thank you. Give me the money. I like this. It's when it goes down. That's the volatility you worry about. And that's just called risk. Risk. I was waiting for you to talk.
Oh, you didn't introduce me. I was kind of waiting for you to say
I didn't
was.
do an introduction. Okay, let me do an introduction.
All right.
Let me go back
Please.
and I'm just going to go risk. And speaking of risk, one of the riskiest things we do is get together and do this show, which is why we do it 3,000 miles
I thought you were going to say putting me on the podcast.
apart. Yeah. Here in Florida, where our national bird or national mammal,
which I'm
or
going to show you
national
right
creature,
now. Yeah.
it's the leaf blower. Ladies and gentlemen, leaf blowers blow here all year long. They never stop. Whereas in other parts of the country, it's like only snow blowers, and they don't blow that often. I'm Don McDonald in Florida. They're in the Seattle area where the leaf blower season is done. They've all migrated to Florida or Arizona. Is Tom Cock. And Tom, am I right? Isn't the volatility people are worried about really just risk?
Yeah, and people's risk levels go higher when the market, guess what, goes down. We're talking about stock market, by the way. We could talk about bonds too. And their amount of risk they're willing to take goes down when the market goes up. By the way, it should be the opposite because it's...
Wait, you said that wrong. The amount of risk the amount of risk they're comfortable taking goes up as the market goes up. And it goes down as the market goes down.
Let's just start the whole thing over again. What do you say?
I hate this episode. I'm starting it all over.
Because first of all, I didn't come in because you hadn't introduced me. Anyway, sorry.
All right, here we go. Here we have it. Yet another episode of Talking Real Money, the penultimate podcast on pecuniary matters of all kinds. In Florida, where the leaf blowers are blowing away. I'm Don McDonald, and over there in the Model Military Aircraft Museum, in the dead of miserable dark winter, is the Hobbit himself, Mr. Thomas C. Cock.
I prefer troll. That's the one I liked better because it kind of fits in today's world better. Trolling, that's the whole thing. It kind of works, but okay.
He's a troll.
Thanks. Well, that's a nice
on a roll.
Nicest thing you said about me in like a day or two.
On his head. And today's topic is a word. Well, we start with a word. In the beginning, there was a word, and the word was volatility. And it turns out, according to a recent survey, that 64% of you believe the stock market will be volatile in the future. Apparently, 34% don't think it will be volatile. Well, the 34% are wrong. The 36% are wrong, and the 64% are right. Dead on, absolutely right. The market is always volatile. That's why you get rewarded at times for volatility, for the risk that brings. So what we're really talking about, the word volatility is misleading. It is misused. Volatility is not the word. What people are worried about, that 64%, is the market continuing to go down in the future. That's what they're worried about, because if it's upside volatility, who hates upside volatility except a short seller?
Yeah.
Anybody?
This is a great topic.
Anybody?
No, nobody. By the way, the survey was taken by State Street back in December. So, I mean, you can remember people are coming off of what was perceived as one of the worst years in investing history, right? Because you had stocks and bonds. No, not even close. No. Not even close, going back to before the market turned around 2020, for example, or 2008. There's been all kinds of years. But the point of the matter is exactly
more like
what
2011, which nobody even remembers as being a down market.
Yeah, exactly. So, but here's the fascinating thing about all this. We know, because it shows survey after survey, when the market goes up, right? You mentioned this, when stocks increase in value, people feel like, hey, there's no risk. There's nothing. This is easy. When the market goes down, you all feel like, well, there's a lot of risk now. When technically it should be the other way around, because when the market's lower, what are the odds? The odds are the market's going to go up. When the market's gone up, the odds are going to. So your emotions
but the funny
are
thing
exactly wrong.
The funny thing is, though, when the market is going down, the press starts saying, "Boy, the market is incredibly volatile right now." Wait, it's only volatile on the downside. It's not volatile on the upside. There's more volatility on the upside historically than there is on the downside. Bigger up years and more of them.
I find this whole aspect of interviewing people about their feelings about money is fascinating. 52% say they're more concerned about saving enough for retirement. That's up, by the way, from 45% in June.
More worried about that than what?
Then exactly.
Than not saving for retirement?
74% say they're worried about inflation. Well, I'm always worried about inflation, because that's a problem, right? When things get more expensive, no matter where you are in your life. So this is all silly in many ways, but it does bring to mind the fact that, yes, we know, because we look at this and we talk to you, that your emotions play a role in your saving, in your investing, your spending, all of those things. And the reality is you need to figure out a way to push them away, because the more successful people do that. They don't allow themselves to be ruled by emotions in any part of their life, especially when it comes to the money. So volatility, you're right. It's a silly name. I think the better name, frankly, is standard deviation, but that's too technical.
No, that means nothing to people. Okay, I just like the word risk. Risk. Because that's the feeling. That's how it feels. It feels more risky. So, let's talk about risk. The problem is you need to. Here's my idea, because instead of just putting it out of your mind, I think that now that we've got another puppy, you should just put all of those feelings in a kennel. Just close the kennel and kennel those feelings.
Kennel those feelings.
I'm doing the darn puppy right now, and she's not screaming.
Shh. Wait, I'm listening. Nope, not hearing the puppy.
She has a I'm being skinned alive scream when you put her in the kennel. Sometimes it's like,
that's
save the world as I know it. Yeah.
You know, what's wrong with just getting a new baby?
They do that.
Yeah, let's get a new baby instead. Here's the thing about all this.
Oh, yeah, no. Done that.
Okay.
Done with
just
that.
Kidding. When it comes to risk, when it comes to volatility, when it comes to your emotions, number one rule is you need to know who you are around money. I mean, that's why we give you, and I think you go to talkingrealmoney.com and click on risk quiz there or something.
It's right there on the buttons, the new buttons at the top of the page. It just says take our risk quiz.
Yeah, it's right there. I'm looking at it. Beautiful. Because that's one way of helping you understand yourself. You need to know yourself about money. You need to know your emotions around all of this, right? Because if you don't, then that's when bad mistakes are made. Number two, once you know that, right? And then you can build a plan, like how much risk you want to have in your portfolio, how much volatility you're willing to accept, where you are in your life, how much risk you should be taking. Figure out how to manage that and make it work in your sort of emotional boundaries. Because the people that don't, I guarantee this because I see it so regularly, they make horrible decisions. They sold in the third quarter of last year. They sold in the first quarter of 2020, right? They got out in 2008 when the market was going down, was, way down, because they let their emotions rule them. So yeah, this is a silly survey, but it does point out the weakness we all have frankly, as human beings that are trying to invest for the long haul, Don.
Yeah, and it occurred to me, we panic. As you said, a lot of people sold in the third quarter because the pain got too great for them. If the market's down for a little while, they can tolerate it. But when it gets to 3, 6, 9 months, the pain starts to become unbearable. And eventually, it's just the only way to feel better is to eliminate the source of that pain, which is the stock market in your portfolio. But that hurts you in the long run. And it's funny. We never, ever, ever. This is how we're risk or pain and pleasure oriented. We never, ever, ever get out of the market going, this just feels too good. I know I got to get out. I'm making too much money. I need to stop. No, please take my money away now. It's fun. No, we never do that. We never do that. We never sell high and buy low. We buy high when it's already been exciting, and we sell low after it has already been declining.
That's exactly right. And so, again, take the risk quiz, talk to somebody, try to rationalize this if you can, and look at your situation and realize that, and by the way, here's the other thing we do know for sure. To make money, you have to take some risk. Now, you can take less by owning bonds. You can take more by, owning a globally diversified portfolio of stocks. But that has been the history over the long time. There is no wealth without risk.
That is a great point. We hear from people all the time, I want a riskless investment.
Oh, yeah. Conservative.
If you want a riskless investment, then your best bet is probably going to be the closest to a riskless investment would be something like a TIPS fund.
Yeah.
Because
Treasuries
you're not going to lose money to inflation, but you're not going to make money net at all. You're going to make really pretty much nothing net, which is what you should expect from a riskless investment. Putting money in the bank, not riskless. Not riskless. Even at 0.01% Bank of America, that is not riskless because you're losing to inflation.
On a very regular basis.
Inflation.
Yeah. Oof. Painful. So it's a great topic. This is not one that we take lightly, by the way, when we talk to you, and nor should you, because it's a very important. We're going to give you the numbers, but you got to know yourself about.
It turns out, though, this is the biggest reason. The number one reason investors need an advisor. It's not to build the right portfolio. That's not it. You can do that. You can probably figure that out. The problem is managing your emotions after you've done that, because it is your emotions that detract from your return. And I'm not the only one saying that. Dalbar has been saying that for years. Vanguard did a very comprehensive study that says you lose to your emotions over 1% per year, just to your emotions. And that's a lot. And then the other you lose when you don't rebalance, which is an emotional thing because it's got to be a discipline. So overall, if you don't have an advisor, Vanguard's saying you're losing about 3% per year that you could be making extra if you had somebody taking that emotional problem on themselves, really basically saying, I'm going to handle the emotions. You need to listen to me. I'm going to counsel you and do the right thing. Building the right portfolio, according to Vanguard, is like 0.2% of your
when
return.
You look at the overall, when you look at the overall benefit you get of having a fee-only fiduciary advisor on your account, that's a small part. But a lot of people, by the way, they don't do it right, even though they know better. So, but it's good. Yeah.
If you like asking questions, we like.
I thought you were going to say like rainfall,
sharing
chocolate,
answers.
Something like that. Okay. Mm-hmm.
Yeah, no, you like bunnies and butterflies.
See my grandson; he'll gladly help
then
you.
Go see one of Tom's grandkids, or one of mine. It's my daughter, Tori.
Well, you better put her on because it's very important.
Let me just say hi. Hi, you're on Talking Real Money.
Go ahead.
She's going to hang up really quickly.
She hung up. I love it. Yeah, she's no dummy.
All right. That was my daughter. You didn't hear her. She was trying to FaceTime me. She just got a new job.
That's good. It's good to be employed.
She got a new job. She's going back into teaching.
Well,
Not
was a
thrilled
very
with the
good
idea
teacher.
of going back into teaching, but she's going to be teaching kindergarten at a
very good at
charter
it.
school in the Bronx.
I love it. Wow,
Yeah,
interesting location. You want to take a couple questions since Tori won't ask a question?
I was getting to that when Tori interrupted us.
Yeah, well,
it's question time here at Talking Real Money. You can send those in at talkingrealmoney.com or call 855-935-TALK. Tom, who's next?
Steve from Sammamish, Washington. I know the place. My 401k offers 2 CIT funds. The principal BlackRock S&P 500 Index, CIT, 0.2 fee. And the principal BlackRock Bond Index, CIT, 0.9. Now, it seems odd that the S&P 500 would cost less than the bonds. My research has found these are not subject to SEC regulations, but are subject to ERISA and other regs. Besides that, the only real difference between CIT and mutual funds is where they are held at banks, who can buy them, etc. My question is, are these vehicles any more risky than a mutual fund or ETF?
No, identically risky.
I think they're same. Yeah.
No, they're still pooled portfolios that are heavily regulated. They can't run off with your money. They will not run off with your money.
I forget what CIT stands for. I'd have to look that up.
Let me look. Isn't CIT? It's CIT Bank.
Collective Investment.
Collective Investment Trust.
Yeah. CIT. Yeah, there you go.
No, and they're held at CIT Bank, which just makes sense. No, they're really not. I'm lying. CIT is a bank that lends out money. Oh my gosh, CIT. Just funny, I did this when I typed in CIT. That's why I said that. They're paying 4.05 on their high yield savings.
Wow. Everybody's coming up past that 4 number.
Yeah, they're the Collective Investment Trust.
There you go. Yeah.
It means it's
a different structure.
Their costs. They're potentially less expensive, although I cannot imagine that in reality they're going to be any less expensive than a comparable ETF. Now, if those are your only two choices,
not great.
Yeah, you're going to need other options outside of this account, either in an IRA or a taxable account, to pick up some of those asset classes that really have shown an ability to add to your returns in the past anyway.
Yeah, I think that's very important. And again, I'd be surprised if there weren't more, because that's very limited to only have large U.S. companies and a bond index. But there's nothing wrong with using CIT, period.
It sounds pretty typical, though, because sometimes it's like, let's just do this. We're just going to do the S&P 500. We call that the market, and we give them the bonds. They're happy.
Yeah, not much. Okay, we got time to squeeze one more in from Eldon in beautiful Chicago, Illinois, where I read it was like 8 below zero not too many days ago. Don't do well in that.
I used to live in Chicago.
Yeah. Oof.
Cold.
Yeah, it wouldn't do me well. Desperate for more insight. I came across your podcast recently. I'm really enjoying your show. I'm having trouble determining where I'm allowed to park. I don't like that term. Park a large settlement that I intend to use for retirement 20 plus years away. Park generally refers to something shorter term, I believe, but we can talk about that in a minute.
No. Wait, there's short-term parking and there's long-term parking.
That's a good point.
At the airport. You have to walk further from the long-term parking, but you pay less.
Yeah.
So
and remember, don't fly Alaska Airlines. Anyway, and I'm
it hasn't aired yet, so no one knows.
Oh, no one knows that whole story. That's coming. Stay tuned for a future podcast. All right. The IRA and 401k options appear to require earned income, which this is not. And that's true. You have to have earned income to put money into either one. I'm not interested in an annuity. And here's the part you're going to love, Don. I want it to grow while limiting negative tax consequences.
Oh, you want to make a lot of money and pay no taxes? Well, that's good, because that's easier to do. That's actually a lot easier to do than it is to make a lot of money and have no risk. Most people say, I want to make a lot of money, but I don't want to take any risk. And that really is the crux of the matter here, is how much risk are you willing to take to make a lot of money?
And how much?
He doesn't say, I assume.
Volatility. No, he doesn't say. That's the end of the question. And so again, limiting negative tax consequences. So if you take the money,
Well, that would be an
for
ETF.
example, well, that's true. I mean, but you're still going to have a potential tax consequence when you go to sell
limiting,
okay.
not
Doesn't
eliminating.
Nate, okay, fair enough. But he was also asking about 401k and IRA options. There, you're just deferring the tax, by the way. That's not eliminating it.
Right.
There's always going to be.
Plus, you can't
it.
do those. Those are out of the question.
Got to have income. Yeah.
You got to have income.
You raise a good point. Then open an after-tax brokerage type account, use exchange traded funds, which are very tax efficient, and get on with your life. And as Don points, the bigger picture here is take the risk quiz, try to make some decisions about your stock to bond ratio, how much in riskier things like equities versus less risky in bonds. I think
it's a matter of fact. If you go to Talking Real Money, the new website right now, talkingrealmoney.com, right there below the picture of the stock traders, which we are not, you'll see a button that says, take our risk quiz. On the second page of the risk quiz, after you're done, it'll tell you what your stock to bond ratio range is, approximately. Then move down 2 buttons to DIY portfolios. And there you will see a 2 ETF portfolio, a Fidelity 3 fund portfolio, and a Vanguard 2 fund portfolio.
Wow.
If you use the ETF portfolio, that will potentially reduce some taxes, although Vanguard now has structured their funds to where they don't distribute capital gains either. So you should be okay either way.
This all sounds really good, and it looks really nice too, and it smells okay. So you go for it. Sure, why not?
I haven't put the smell module in yet.
Oh, I guess
they're
making lunch down the work. Okay.
Yeah, I was going to say it's not my fault. Whatever it is, it's not my fault. The smells, those are your problem.
By the way, I've been spending all this time trying to find park investments, but they keep sending me to South Korea. I can't find for the life of me.
What are you talking about?
Well,
parking?
When they say parking, I that to me means temporary.
I agree with you, but here, let me make that easier for you. Is that what you're trying to figure out?
Internet search,
I'm
and it
sorry.
wasn't working.
Well, I just use a thing called a dictionary.
That's a good idea.
I just like dictionaries.
I'd not considered that. Yeah,
they're kind of nice. So to park,
which had a different meaning when I was younger, of course, but still.
Wait, I got to find it here. That's a park. That's not what I want. I don't want that kind of park. Nope. I want a place to park. Basically, parking means to leave, station, position, or stop. So it basically can be anything because it says
there's
leave.
No term to it because I thought it meant like temporary. Okay. All right.
That would be short-term parking. Short-term parking.
It's available 3 aisles down on the left.
You can. I wonder if you can permanently park. Yeah, I guess when you die, you're permanently parking.
Permanently parked.
Yeah.
You're not available to move.
There's no motion. You're permanently parked.
Oh, God.
That's it. I want to be in long-term parking at OIA. That's it. I just put an urn in long-term parking at Orlando International Airport.
Maybe somebody will take you for an international travel somewhere. They'll take you off somewhere fun. I don't know. Whatever.
All right. Yeah, we digress so much that we got to go. We do. We just have to we have to done this. Yeah. When you have a 10-week-old puppy in your house.
Oh, here we go. Okay.
Your brain gets fried because they're so smart and so inquisitive and so cute and annoying at the same time. It's like the love-hate relationship. You want to hug them and you want to kill them because they do everything it's like the movie. Puppies are everything, everywhere, all at once. Soon to win an Academy Award.
That's coming soon. I'll be watching.
Have you seen that movie? You haven't seen that movie yet, have you?
Nope.
It's on Showtime.
Well, which I do
Academy
get.
Award
One of the channels I pay for. Okay.
It's.
I don't watch a lot of dog movies, though. I don't know.
I'm joking. It has no dogs in it.
Oh, okay. I thought you said
I
something
was
about
just
dogs.
using the name to say what a dog is. Everything. There's not a dog in the movie.
Ah, okay. All right. Very good.
It's about a woman and universes. There you go.
That sounds too complicated for me.
It's complicated. Debbie watched it and went, I don't get this.
I just learned that even in our own little solar system that Saturn's 1 billion miles away from Earth, which shocked me because the sun's only 93 million. Go figure that one out, huh? Oh.
It's farther away, Tom.
It's way farther. It's like 10 times farther. I was like shocked. I had no idea. I was like,
do you know the universe is like billions of light years?
Dude, we don't got that much time on this show. I'm gonna. My brain.
Do you want me to try and explain a light year to you?
I got a fragile. You said was my brain like it was like can't.
Your brain is no longer
anymore.
spongy.
Yeah,
it's just stiff and doesn't soak stuff up. Brittle brain syndrome.
Exactly. Like criticism. I don't want to hear it.
I promised we were going to end the show, and people are saying, end it now. Put it out of its misery. I'm done. That's Tom. Eventually, we'll be talking real money again.
We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. Providing personalized financial planning or investing advice takes time, so please consult with a really good fee-only fiduciary investment, tax, or legal advisor. We know a good one. Investing must always involve risk. In other words, you can and probably will lose money at times. Also, as much as you want it, no one can accurately and consistently predict the future, so past performance doesn't tell you a darn thing about what the future will bring. Unlike many other programs that say something similar, Talking Real Money is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Capital, a fee-only registered investment advisor. Thanks for listening, and please visit TalkingRealMoney.com for more information and disclosures. Are we done now?